Good evening, everyone. Welcome to the Venture Foundry series. This is session 3. We have Craig from Holocene who's joining us today. So excited to have him here. Before we get started and I hand over to Mr. Thabelo to, introduce Craig for us, I just want to lay down the ground rules. You are more than welcome to switch on your camera. I see I didn't enable that today, but I'll enable it for everyone so that we can see you. And then please keep all mics off. You'll then unmute when it's time to ask questions. Please save all questions for the end. If you think of something during Craig's talk, please just put it in the chat and then we'll come back to it. And then once it's time for question and answers, I will then let you know how exactly we will be working with those. So I will be handing over to Thabelo now. And just a note, I'm not accepting any note takers. We will share this recording. Thank you.
Okay, thank you, Ntsiki. My name is Thabelo, not Mr. Thabelo. My name is Thabelo, and thanks everyone for making the time to come to this session. Very important to engage with ecosystem role players like yourselves, because our belief is that you as founders, you are actually on the center of the ecosystem. So everyone that exists around the ecosystem, being the investors, venture support organizations, government, DFIs, corporates, all exist to support you. And it's important that we engage with you. So this is very important for us as Savant Foundry. One thing that is very important that I like to highlight every time during these sessions is that as an entrepreneur or as a founder, you need to understand that the product that you're working on, it's just one component within a much broader system called a business. And there are many requirements for you to build a sustainable business beyond the product, which can be the team, can be funding, can be the customer. And today we've brought on Craig from Holocene, who will be talking about anything and everything around commercial funding. We've discussed in our previous sessions, talked about non-dilutive funding from government. We've brought in an angel investor as well. And today we brought Craig, who will be talking about more commercial funding that is more interested in business fundamentals more than anything. So we have realized the gap where a lot of founders that we work with by virtue of working with the universities, with research outputs, they are mostly more, I will call it grant junkies, because that's what we call it. And when they approach funders, it's difficult for them to get funding beyond the likes of Technology Innovation Agency or government-backed institutions and maybe corporate ESDs that may be more impact-driven than business fundamentals. So very important that you understand that you need to articulate your business opportunity to a VC from a more commercial or return perspective. While the impact is important, but commercial money, it's somebody's investment, and fortunately enough, they would want return on that. And it's important for you to articulate that when describing your business as an investment opportunity. Without wasting any time, Craig, over to you. Thank you.
Awesome. Thanks, Thabelo, and thanks Nsiki for the for the opportunity to be here. I'm gonna present just literally one slide just to give a brief overview of Holocene, but and then just gonna explain and I do want to caveat up front that there's no kind of Bible or clear way to go about fundraising specifically on the commercial side. It is very specific to different funds. So I'm going to talk through how we at Holocene have kind of seen the world from a pre-seed and seed perspective, how we go about it, and what we feel are just important things to get right in order to raise the type of funding that we look to do. I'm just going to share my screen quickly to run through the Holocene offering. So yeah, effectively Holocene is a pre-seed seed investor in the climate tech space. We're investing between $100,000 and $250,000 into startups across Africa. Currently, our portfolio is 60% South Africa, with the rest being in East Africa. Some of our investments in electric mobility, like Scoot Hero and Yongezo, are doing electric vehicles. We have Faro doing circular economy and fashion, farm to feed on the agri side, and some other carbon plays. Yeah, we've been around for the last well, in Holocene's form, we've been around for the last 2.5 years. Before that, the team worked at Stellenbosch Launch Lab, so had experience in working with the technology transfer out of the universities. So have a lot of experience in working with ventures that are just starting out and looking to get their first commercial funding, to get their first customers. And yeah, I'm just going to talk through kind of the approach that I would suggest. I'm going to stop sharing now, as I'd really want this more to be a lot of questions and conversations more than anything else, due to the fact that it is so subjective, this fundraising journey that you go on. I think one of the things from a Holocene perspective that I really appreciate when a founder approaches us is a founder that really has taken the time to do research and understand the investor. I very often get founders approach me with, or approach Holocene, for example, with no understanding of what we invest in, what stage we invest in, what geographies we invest in. I think it's crucial at the starting point to almost do diligence on the investors that you are approaching. So understand the stage they invest in, their geography, how much they invest in, what types of companies, and also if they can add strategic value. I think when you're at the start of your journey, bringing in the right investors that can add not just capital, but also strategic insights and value to really add depth to your company is really, really important. Go onto their website, look at their existing portfolio, try and reach out and chat to the founders of the existing portfolio to work out if you are a fit. And if you can approach an investor having said, I know this about your company, I know this is the stage, this is why we're a fit, immediately you're starting on the right foot. I would also avoid here in the day and age where you can dump a company website and some information into Claude and produce 100 emails and send them out to different VCs. I'd really urge you to avoid that. It's very easy to understand if it's AI slop and coming off as inauthentic. If the investor that you're approaching means a lot to you, take the time to really understand it and convey that you've really done your work. Once you've engaged, I think there's obviously certain things that you can control and that you can't control. One thing, or a few things that you can, is really control the quality of your data and the quality of the information that you presented. If you have traction and you started generating revenue, make sure that those financials and the management accounts are in place. It's some of the first things that people ask for, that you've got a budget. And secondly, I think, or lastly on that, before I move on, is just understanding your market and showing that you've done the work to understand your market, whether that's with customer discovery, that's with knowing these are the key players, these are the key competitors. Really control the controllables in terms of the information that you have on hand to offer an investor. There is obviously a piece here now where, when assessing the strength of an opportunity, either the opportunity is strong in the eyes of an investor or it's not. So what I'm talking to here and what we look for is quite specific to Holocene based on our thesis. There are certain things that are transferable across VCs, but I'd say there's 4 key things that we look to. The first and foremost, because we are investing in quite early stage businesses where there might not be a lot of operating history, the team is a crucial part of our assessment. If we look at our ideal founder profile, it's ideally actually 2 founders. It's not saying that a single founder cannot go and do it, but having a founder that has technical expertise and then a commercial role, the ability to sell, to us, that's hugely important, as it de-risks the path of the startup going forward. And one of the things that we like to see at Holocene is something we called earned insights. So what have you developed or what have you done in your career that really gives you the earned insight into this problem that you're trying to solve? It is the reason why, if we look across our portfolio, most of our portfolio companies are led by founders that are experienced operators that are, if I look at our profile, are normally 35 to 40 years old, having had a career in this certain field that they're working on, and really understand the problems that are just inherent to the sectors that they're operating in, to really understand the problem, understand why their solution fits into what they're trying to solve. It's not to say that a young entrepreneur can't be successful. It just means that the bar is higher because you don't have that track record and that ability to lean on the experience that you've had in the past. Yeah, candidly, the bar is higher because there's less proof to what you can do. The second piece after the team is, as I touched on briefly, is the problem and the market. So if you have a well-defined opportunity and the ability to really build your market opportunity up from the ground up, I mean, a lot of investors talk about a top-down analysis versus a bottom-up analysis of the market. We really favorably look on founders who can articulate their market from the ground up. And what that means basically is to say, cool, I've got my product and I can identify 10 to 20 customers that I've gone and actually chatted to, and I can articulate the problem that they're experiencing. I can understand the price they're willing to pay to solve that problem, and to say, out of those 20 customers, I can generate $50,000. If I then extrapolate that across, say that is in Johannesburg, I extrapolate that to Cape Town, to Bloemfontein, to the rest of South Africa, I can clearly see how the opportunity scales into something that's interesting from a VC perspective. So that is one thing that we really value, is the ability for a founder to really build up their market from the ground up, and not just download some statistical website that says the market is growing at 30% CAGR and it's $1 billion opportunity. That says nothing to us about your ability to articulate the problem in the market that you find yourself in. And that ties into as well is knowing your customer. I think we invest, Holocene specifically is typically a post-revenue business, but regardless, if you're looking at funds that invest pre-revenue, the ability to know and articulate your customer profile is really important. Even if you haven't generated revenue, if you can go and say, I've chatted to 10 to 20 customers, I've got meeting notes to prove, I've got discussions with them, at a minimum, your customer discovery and your level of insight into understanding your customer needs to be just, top of the pops to really get that conviction that you know what you're talking about and that you can go and solve a customer's problem. So we've got team and then product and market. The third piece for us specifically is your solution set. We like to talk about having a clear value proposition. And what that value prop is, I can drop it in the chat at some stage, but we like for a company to be able to articulate their business really in one sentence. And that is, you have a product or service that helps customer X benefit by doing Y. If you can clearly distill your business into, say, you have a product that helps a target customer, and what is their benefit by doing Y, like that, to us, having that clear value proposition just cuts away all the fluff, and it really just proves to us that you know the problem that you're trying to solve and who's going to benefit from your solution. So we're quite big on knowing your value proposition. For us specifically, we don't take, and candidly, a lot of commercial investors in South Africa, venture investors, don't necessarily take technology or product risk. What that means effectively is most commercial investors will only invest once you have de-risked the fact that this product actually works and that the technology actually works. So the way that you do that is to have an MVP that's worked, that's proven in a commercial environment. You have a pilot, whether that's paid for or unpaid for, but you can show that this has been operating in the field for a couple of months and you've de-risked the technology or the product to a certain extent. There are a couple of investors that might do take tech risk. I think Savant is actually a great example of that, where they have really strong engineers on their team. They can look at an opportunity or a solution set that might be not quite there, or the MVP is still being developed. But they have the technical prowess to assess an opportunity based on its technical potential alone. Us as investors, I'm a finance guy. I've got a keen interest in physics and engineering, but I won't be able to tell you if your technology is not proven by customers willing and wanting to use it. That is kind of our commercial test case for whether this solution is actually interesting. If you are going to raise before you've done this, you need to be even more careful on the investors that you're targeting, because they've got to be really technical investors in the field that you're operating in. So that's the third piece. So we've got the team, the problem in the market, and the third one being the solution set. The fourth is traction. This is also an important one that I've mentioned previously about knowing your investor, knowing whether they invest pre-revenue. Do they invest pre-revenue, or is it only post-revenue? And if it's post-revenue, you've really got to be clear on what you have done, how many customers you have, how much they're paying for it. There are levels to it as well. Holocene, for example, is not strictly a post-revenue investor, but as I've said before, the tech needs to be de-risked. So there's an interesting kind of classification of traction that we look at. The top being you have paying customers. The second level, you have engaged customers. So whether a customer has a pilot that's under a free pilot for the last 3 months that you're engaging with them, that you're testing, that you're co-developing. And the last or least interesting from a traction perspective is interesting leads. So those are things like LOIs or MOUs. To be honest, we put quite little value in those types of things unless they've actually tested your product, they've actually done the work to understand the value of it. If they've just got an LOI saying, if you do this in 1 year or 6 months, we might look at the opportunity, it's not that valuable. You really need to have a qualified lead and an engaged customer that's willing to use your product. The last piece that I'll talk to, and I think Thabelo, it's nice that you guys have covered non-dilutive capital as well as an angel investor, because they all work together. All these types of fundings do work together. As I've said before, like pre-revenue investors, at least institutional or venture firms, are very unlikely to invest on a pre-revenue basis. So our advice to founders, and I just want to also candidly say, South Africa is by nature, we found quite a conservative capital market, in that it's not like Silicon Valley where you can go and pitch an idea to a VC and they'll give you $1 million. It's not that way. So I just want to be transparent that it is getting that initial traction and getting that initial funding is very tough to do. The way that we typically see it with our founders is because of the experience that they've built up a network of people and trusted colleagues and trusted connections that might be able to just back you on your quality as a person, on your insights, on your ability to execute. And we call that, that's angel investing. It can also be friends, family, and the third one being fools. But that is a really crucial first port of call for funding, is tapping into the networks that trust you without proving your product at all, without proving or de-risking anything. I think there's a really cool video of Mark Andreessen where he explains the onion theory of risk, which I really enjoy, is that investors, with each funding round, you're peeling away a certain layer of risk. So when you're going to your friends, your family, they can accept all types of risks because they back you as an individual. When you go on to an institutional investor, you need to have peeled away certain layers of risk. That might be tech risk, that might be team risk, or whatever it may be. And an early stage investor might say, cool, you've peeled enough risk away, we'll invest here. Then you get further along the line where you get to a Series A investor when you need to have peeled away even more risk, and that is commercial risk, that's go-to-market risk. There's just a lot more expectations on the level of risk that needs to be peeled away from your opportunity the further you go up the funding ladder. So at the start, friends and family, and also grant funding. I think specifically in climate, there's a lot of grant capital that is available. Do the work to go out there. It's tough work and it takes months. It can take months and months, but it is the type of funding that exists for founders and opportunities that might not necessarily be ready for commercial capital. So tapping into those angels and non-dilutive grant capital is crucial, specifically that we see in climate. And then lastly, I think certainly the businesses that we look at is a lot of them have a hardware component, and you can fund hardware with equity up to a certain point. But what we try to do is once we've invested, it becomes crucial to start thinking about debt. It's to start thinking about how can you convey to a debt investor your unit economics of your product, to say, if a product or an asset costs $50,000, we can show that the repayment period is, through the data that we've gathered through our equity, we can show it's repaid in 2 years, 1 year, 3 years, whatever it may be. But debt becomes a crucial thing to unlock once you've proven the product. But the actual recording and the measurement of how your business is doing needs to start from day one. So you have that history that you can go to a debt lender, and they have the ability to really stress test your data. So yeah, that's just broad strokes on kind of the things that we look for and the suggestions that we would give to founders. And as I said, this is our view as Holocene and myself as one investor in a big ecosystem, and not every business is the same and every business has different problems. So that's why I'd rather just open up the floor as soon as I can and address any questions. No question is stupid or insignificant. So yeah, looking forward to chatting a bit more, and please do feel free to ask away. Cool, thanks.
Right. Thank you so much, Craig. So we're going to open the floor up for questions. How it's going to work is you can either type your question in the chat or you can raise your hand. I am going to take 3 questions per round. You can only ask 1 question when it is your turn, and you cannot ask follow-up questions until it's the next round of questions, okay? So I'm going to take the first 3 questions. I already have 1 in the chat and 1 raised hand. So when I call your name, you can then unmute and then ask your question. Craig will only answer after the 3rd question if we have 3. So the first question is from Simba. He's asking, how do you evaluate the climate positivity of an LPG efficiency play versus a pure renewable energy company? What makes the climate case strong for you? And then I'm going to ask Stephen to unmute and ask a question.
Sorry, Tiki, I wasn't clear.
Stephen, sorry. Stephen,
should I ask my question now, so you can answer Simba's
yes,
question?
ask your question. 3 questions,
sure,
and then he'll
cool,
answer.
okay.
So you can ask yours, yeah.
Cool. So thanks, Greg. Firstly, it's very useful insights. I really appreciate that. Second, I'm an M&A lawyer, so my perspective is more focused on the technical investment side. So not necessarily the climate focused businesses you work with, but especially the investments. I want to understand more clearly from a Holocene perspective, what kind of instruments do you invest in? And same question, what kind of returns do you typically go for? Do you like a kind of carried interest or kind of liquidation preference or something like that? Or is it normal ordinary shares you just rank pari passu with all the other shareholders? Thanks.
All right, thank you. And then, Oki, Van Wyk, you can go ahead and unmute and ask your question.
Hello, yes, thank you. I saw on your slide that you are doing invest in agribusiness. Can you just give me some idea of what agribusinesses you have invested in so far, please?
Cool. And Siki, can I start answering? I'll start with the first one, I assume.
Yes, please. Please,
Sure,
please.
sure. Cool. So yeah, the climate question, firstly on the LPG side, and this is again very specific to our fund, is that we don't invest in kind of transitory or opportunities that aren't clearly climate positive. So LPG, for example, is not something that we would invest in, purely because there is still, although it's much better than burning petrol or diesel there, it's not a purely climate positive play. The way that we measure climate mitigation is during each of our IMs, we will look at the opportunity and look at the displacement of carbon over a certain year. So a good example is electric motorbikes. I think on average they're compared to their ICE equivalents are essentially mitigating 1,500 tons a year of carbon, and we'll articulate that across a fleet, across an entire market, in order to quantify the climate impact. But yeah, unfortunately, something like LPG wouldn't fall within our mandate. Yeah, and on the investments, on the instruments that we invest in, yeah, it's a good question, and I think some investors might know about a SAFE agreement. It's called a Simple Agreement for Future Equity. That was actually started by Y Combinator. We used to invest with SAFEs. The problem with that is, candidly, our Reserve Bank doesn't really know how to classify those instruments, whether they're debt or equity in nature. And because our fund is in the US, we need to be very clear on how money gets into the country. So we actually invest in, it's very similar to a SAFE, except it's a convertible note. So there is a forced maturity after 24 months. So what that technically means, and again, I'll go a bit more technical if it's an M&A lawyer asking the question, but effectively what it will look like is a loan that has a maturity of 24 months. So $100,000 investment, it would bear interest of 8% per year over the 24 months. And then at the end of 24 months, effectively, there's $116,000 that is repayable, the principal of 100K and the 16,000. But we never expect repayment from that investment. So we'll convert into equity at that time. What that means is at investment, we'll set a valuation cap, which is similar to a SAFE note. For example, if we have $1 million cap on a $100,000 investment, that would be a 10% excluding interest. If we add an interest, what will that be, around 16% that it converts into. And yeah, in terms of like what we hold, so that would be depending on the types of shares that are available in the company. We convert into the most preferred share that is currently issued. So if there is a funding round between our investment and the maturity, and another investor gets preferred shares in the company, we'll convert into preferred shares. But if there's no funding round between the time that we're invested and our note matures, we will simply convert into ordinary shares and sit alongside the founders. So it really depends on the type and the class of shares that are available at the time that we convert. From a returns perspective, so we have, our fund is not huge. It's $3 million. So the way that the lens that we kind of approach it for every investment is to say, how does our investment return $3 million? Essentially, how does it return the fund? Which is a very different prospect to where you have an Andreessen Horowitz, where they have, billion-dollar funds, where that has to be a billion-dollar outcome for it to be interesting to us. But for us, it's to say, if we put $100,000 to $200,000 to work and earn between 10 and 20% equity in the company, what do we have to exit that company at in order to turn that $100,000 or $200,000 into $3 million for the fund? And what that normally looks like is, if we are quite strict on the valuation cap that we apply at the time, is normally a sub $20 million exit. And that is the best case scenario that we look at. We say, what does it need? What is a company now valued at $1 million? If we can exit our position at sub 20 million over the next 5 years, that would be a fund returner for us, which makes it a compelling opportunity. There certainly are opportunities that we've invested in that don't have that trajectory. But at a minimum, we look at a 5x type of return on our investment. The reason it's at 5x is, and some of them would be lower, obviously. 3 to 5x it can materialize in that way, but we've at least got to have a investment case for a 5x return. The reason being is that there's another return metric that we have for our investors, so our LPs. And that metric is a 30% IRR over the course of the fund, i.e. they've invested at final close of the fund, and we have to realize a return of 30% annualized over the 10-year fund, which obviously means we have to have outsized return outcomes. And obviously, the sooner that we return capital, the higher our IRR is. So when we invest, we're normally looking to exit within 5 years of investing in order to make sure that IRR to our investors is as high as possible and at least 30%. So yeah, I hope that answers your question. And then the last one on the agribusinesses. Yeah, candidly, agriculture is not a core part to our thesis. Our portfolio currently is around 60 to 70% renewable energy and electric mobility. So that is a core focus for us. But we look across climate verticals opportunistically, and agri is one of those. The agriculture investment that we have made is not necessarily agri-tech, so to speak. It's not a farming solution. It's actually an aggregator and B2B marketplace of fresh produce. It's a company called Farm to Feed, which effectively their business model is they have a network of smallholder farmers through which they aggregate produce. And that produce and their value prop is to take the full harvest. So to say, we've got a couple of broken carrots, we've got some odd-shaped potatoes, we'll take your full harvest, and we will be responsible to process that in a way such that our commercial buyers don't actually worry about the fact that they are odd-looking. So that, from a climate perspective, is obviously reducing food waste, which has obviously considerable methane emissions as it rots. And that is our only farming investment to date. Before the fund, we invested in a company called IAS that was doing a bit of crop spraying, and they had a drone type of solution, but again, not a purely agri opportunity. We do look at them and we assess them, but yet to make kind of a pure agri play. I think most of the opportunities we have seen are selling apps and selling tools to smallholder farmers, which to us is a really tough customer profile to pick, purely because of affordability. I think in South Africa, it's obviously a bit different. If you can prove that you have a solution that you can sell to commercial farmers, it's a much more compelling opportunity. But yeah, yet to invest in that space from a South African perspective. Yeah, I think those are the three.
Thank you so much, Craig. So there's one question in the chat. If you have any other questions, please raise your hand and then we'll take those questions. But the question in the chat is from Siposetu. They're saying, "Hi, Craig. Thanks for the presentation. I work for Propeller Incubator in Gqeberha. Would love to know what areas do you focus on? Would innovations on this side of the country be appealing?" And then we have a hand from Clint Davis. You can go ahead and unmute and ask your question. Clint, you're
Hi,
on.
hello, Craig. Thank you for the presentation and for clarifying from your side on the supply side. What are the requirements that you look for in terms of funding applications and so on? I think it's firstly, from the point that I'm asking the question, it's really quite staggering that there are so many startups and founders who are interested in starting up a business, but they're looking towards finding funding as almost a prerequisite to getting the business off the ground. Not specifically, for example, looking at the areas like having your problem well defined and having your solution and having your team and all of that. And another profound thing is that only 1% of startups, I think, in Africa are actually shown to actually get that kind of startup funding that they are looking for. So from the supply side, but I'm trying to understand it from the demand side very, very specifically, because I'm from the ESO sector formally, and I'm trying to, understand what it is that founders get wrong. So from your side, what are the most, perhaps one or two common areas that you see as weaknesses in turning down startups?
Okay, thank you so much. Do we have one more question? All right. Craig, you can go ahead and answer those two.
Okay, cool. First one, a lot easier than the second. First one, yes, we invest across the country, across Africa. So would love, if there's opportunities in Quebec, yeah, would love to see them. So yeah, I think our website, there's an application. We look to turn those around within the week. And if there are more than one opportunities, we welcome a chat. And yeah, if there are a couple, feel free to reach out to me on LinkedIn, and we can organize a chat more broadly about the opportunities that you're seeing. So definitely interested. In terms of what founders get wrong, it's a really broad question, and I don't think I wouldn't categorize it as wrong per se. It's more to say what things can you do in order to be looked at more favorably. I think in terms of immediate or easy declines from our side is what I referred to in the beginning, around where someone just has no idea about what you as a fund invest. I've had numerous fintechs and crypto companies apply and reach out to Holocene, where they've clearly not even taken the time to understand that we're a climate business or a climate investor looking for climate positive solutions. So that is top of the funnel, just purely not understanding the investor that you're chatting to. And I think that it's not even just surface level. If you've got to the place where you are a climate positive venture, go and have a look at the portfolio, look at the types of things within climate that we're investing in, go and look at the types of businesses and portfolio companies, and go and just do your diligence on the investor. I think it immediately stands out if you can really talk to the fact that you've done research on the company and why you really want this firm as an investor. So that would be my starting point, is really don't go and get a lead list of 200 VCs off some AI generated site and punch out 100 invitations. That's not the way to do it. So rather than shotgun, I'd go with a kind of sniper approach, for lack of a better term. Other than that, in terms of what they get wrong, it's an interesting one where I think founders sometimes try and raise too much too soon. There is a kind of a benchmark that's set in the global north, where your starting point is you raise $1 million at a $5 million valuation, call it 100 million rand in South Africa. There are businesses in South Africa that are producing close to 50 million rand that aren't worth 100 million rand. Like, starting off with that valuation and raising 20 million rand off the bat is just, in our view, not the way to do it. I think you need to be very specific about how you plan your fundraise. The way that I do it, first, there's two things to consider as well. Like, firstly, you don't want to dilute too much at the start of your business. If you're raising or go and raise $1 million, firstly, the $5 million valuation is going to get whittled down, which means that you dilute too much. And secondly, there aren't investors that will write those big checks without serious traction and serious ability to show that you've generated revenue. So if you're doing less than R1 million in revenue, and you're trying to raise money, you must just realize that there's no ways you can go and raise 20 million rand. Like, raise as little as you possibly can in order to achieve the milestones that help you show further traction. So be very clear on the amount of money that you need and never raise more than you need. I think that would be an important one to get right. And also just tying into that is on the valuation piece. You must realize, like, once you set a valuation or an expectation, you are going to be forced to beat that and improve on that in the next 12 months. If you start off with what you believe your company is valued at, call it 50 million rand, and you don't show a significant step change in 12 months, it can be detrimental to your company, because you might have to do a down round. You might have to raise at the same round, offering more and more dilution. So just my suggestion would be to just raise as little as you can in order to de-risk the investment as much as you can, and keep your expectations of valuation manageable, purely because firstly, an investor is not going to look, certainly in a South African sense, and secondly, you're setting a bar which is very tough to beat. If you're playing the venture game, you have to be improving on that valuation at each funding round. Otherwise, you end up being a bit of a zombie VC, so to speak. I mean, in terms of getting things wrong, as I say, there's countless things or reasons why a VC might reject you. I would just say control the controllables, and that's doing your research on the investor. And secondly, having all your ducks in a row in terms of documentation, in terms of having a really well-oiled pitch deck, having good financials, having a really robust financial model, having talked to your customer. Control the controllables is what I'd say. The rest, there is an intangible aspect to raising capital, but do what you can to cover all your bases.
Thank you, Craig. We have a hand. Peace, you can go ahead and unmute and ask a question.
Hello, hi, evening. Am I audible?
Yes, you are.
Yep.
Fantastic. Good evening, everyone. Craig, we applied for last year, I think it was. We applied for the Savant build cohort, I think it was. Our application was rejected on the grounds that we didn't have any traction. We've since made some progress from then, and we now have active pilots. We have POs in place for our tech. So we are an IoT solutions provider for the healthcare space. So we make hardware and the software that accompanies that hardware and monitors the data that's being collected by the devices. And we are looking to raise capital to scale up our operations. So we have an agreement with the client to scale up pilot exercises across Johannesburg region. And we're trying to raise capital to reduce our cost for manufacturing and also our operations for the next period as we complete our pilot exercises. So I wanted to just put that out there. And also, we are now, it's not really much of a question. I'm just hoping that this time around, maybe our position is a bit different for when Savant maybe assesses our application in terms of how they can help our business grow. That's just a general input. So I don't know what we missed, but I'm hoping that we're ticking boxes as we move along, and just hoping that we are in a much better position to get assistance from Savant this time around. Just putting that out there.
Cool. Thanks, Peace. Yeah, I'm not on the Savant team, but certainly sounds like you've gone about it the right way in getting some pilots, getting some purchase orders. So yeah, I'm holding thumbs for you too. But that's not up for me to decide. Good chat to Thabelo.
Yeah, thanks. Thanks.
Pardon me, I joined late. I'm sorry, I joined this like 30 minutes late, so I missed the first half an hour.
No stress.
Yeah, no worries. I mean, I think it's good that you bring that up, and the fact that you applied for our build program. Then I think I'm not too sure if it was this current one or the previous edition, However, it's important to reach out. Our website, it's always open, always have a form that you can apply at any time, always looking proactively on pipeline, be it whether you're applying for the Foundry pre-revenue opportunities or post-revenue opportunities like the Build program or the Savant Venture Fund. And maybe while we wait for other questions, I think, Craig, you touched at a very important part in terms of the investment ecosystem. And it's something that we have also observed as Savant, that a lot of founders don't understand the funding landscape, if you can put it like that. So it's very critical or important that as a founder, you first you understand the stage that you are in terms of your company, be it pre-revenue or we still have technical risk, team risk, and map that against the funding ecosystem. So if you look at if you approach a traditional venture fund or a Series A venture fund with a technology that still have or a product that still have tech risk, by design, that's a straight out decline from a hard filter, right? And it can significantly discourage you, and maybe end up saying, look, there isn't enough funding, or they always rejecting me. But it's just by virtue of not really understanding the funding landscape and the stage that you're in. So if for example you still have tech risk, maybe non-dilutive funding opportunities like your government, technology innovation agencies, your CEDA, maybe those are the kind of institutions that you need to be approaching, as well as angel investors. But once you've gotten that proof of there is a problem solution fit, and that can be through an LOI, which as Savant also we don't really put much value on, but there's more value on it if it's an LOI backed by the usage of your product, right? It's somebody that is saying, look, if you go and refine this product to this stage, I will be willing to actually test your product further and potentially buy the product. Those are the kind of things that when you go to a funder, there is actually an incentive for them to invest, and there is proof, because the important thing is the proof whether that validation happened, not on Claude, not on ChatGPT, but it's something that you actually put your product on the hands of the user, be it whether it's a paying customer or just a user of that product. So having said that, maybe Craig, back to you, is to say, what is your view in terms of the availability of funding in South African landscape? Would you share the same sentiment that founders say that there isn't funding at all for businesses in South Africa? What's your view on that?
Yeah, it's a great question to build on. Maybe just to caveat on the LOI thing quickly. I think I don't want to say that there's no value, because I think it ties into your customer discovery if you've gone out and really had the conversations with them, and there is value in an LOI for sure. It's just that certain investors will need to see a bit more. So I just want to caveat, like, going out and doing the work, I think is super important. But to your point about the ecosystem, I don't want to sugarcoat and say that South Africa has the most thriving startup ecosystem when it comes to funding, for sure. I think it's difficult, even when you look at it from an African perspective. Kenya has a lot more VC action. There's a lot more funding for early stage ventures in Nigeria as well. There is a lot of funding for South African businesses once you've got to a certain level of scale, for sure. Like, our private equity market is super strong. But I will say that, I mean, you can count on your hand the number of VCs in South Africa, really. So I will say it's not easy, and that's why I think it's so important to tap into your network, to tap into angel investors, and tap into grant funding, especially and I can say from a climate perspective, if you can be very clever about how you tell your impact narrative to unlock non-dilutive funding and to be very clear on, even if it's not financial milestones, but if you can say we can impact X number of lives, we can create X number of jobs, do your work to really go and try and unlock that non-dilutive funding. I will say, and I said it earlier, like South Africa is by nature a bit more of a conservative market when it comes to our capital markets. But it doesn't mean to say that the funding's not there. I can think of, even, for example, there's grant funding like Develop PPP that has just had a cohort now where there's investors that want to bring non-dilutive capital into the country. You just got to do your research, be on the pulse of all those things. But I don't want to say it's a Silicon Valley type of opportunity. It is tough, and that's why we always suggest like your networks are your first port of call. I don't want to be crass and say if you have a rich uncle, but like honestly, your network is really so important for that early first bit of funding. And even from my side, like the founders we've invested in have put their own capital to work to say, I have worked for 10 years. I'm willing to put a bit of my savings here to get to a point at which I've proven a customer will actually buy this. I'm not sure what the medtech business is, for example, but I'd be curious to hear how you got past not having funding and managed to bootstrap. Because if you look at type of businesses, for example, like Jonathan Smith, who sold Payfast for a huge amount of money, didn't raise a cent of venture capital. So there are ways and means to bootstrap and to get to a place that you don't need huge amounts of funding. And I'd urge you, as I said before, it shouldn't be your goal to raise as much as you can. You should do what you can with as little as possible. I think that is where there's a grit in South African founders that isn't present, I think, in the rest of the continent and in the global north. So yeah.
Yeah, I mean, that's good insight, interesting insight there. And I guess it all boils down to risk. And if founders can de-risk their startup at a team level, at a product level, and most importantly at a market level, you obviously stand a chance to get funding. And the reality is funding is very limited. I mean, as you have alluded to, there's a handful of deploying VCs in South Africa as well as broadly in Africa. And all of them, they're quite risk averse, right? And for all obvious reasons. So you really need to take advantage of be it AI or onboarding co-founders that are maybe more technical or more commercial to try and not raise too early, but at the same time bring in resources in a way that can actually progress the interest of your startup. So maybe Nsiki will take the next question, but my last question to you is, what are the typical turnaround times for somebody to get investment from you, and to what extent is data room readiness to you guys? But maybe Nsiki can put that question from the chat first.
Okay.
Okay, thank you so much, Thabelo. So in the chat, it's more a comment from Clint just saying, I know the power of family funding. My dad founded my deposit on my first business. Lucky for him and me, I paid him back within 3 years, including dividends. So
Nice.
I have a question. I have two, but I know I cannot break my own rules, so I'll ask one. The other one I'll save it for the next round. So my question is, once a venture is funded, what changes in the relationship? So what does Holocene or any investor really expect from a funder post investment that founders, oh my goodness, that founders are sometimes not prepared for? I think the data bundles are depleting. It's the end of the day. But yes, that is my question. So that is my question. Do you have another one? Anybody else have a question? Okay, I think you can take that one.
Cool. I'll start off Thabelo, with yours, just it's a quick one. Our turnaround we aim for is 12 weeks, so 3 months from meeting to funding. Obviously, that really depends on the quality of the data, and for everything to go swimmingly, I think, and founder responsiveness. Like it's crazy the number of times I can say where someone's applied, and we ask for information and it takes 2 weeks to get information. So 12 weeks is what we aim for on a best bet basis. And maybe to allude to what do founders do wrong is like, if you want a VC to invest in you, like it's hard work, it becomes part of your job. Reply promptly, reply with great feedback. Don't let it. Deal fatigue is a real thing. You need to stay front of mind for investors. Stay in his inbox. If he messages you and emails you and asks you, you make it a priority. Fundraising is part of the job if you're going that way. So 12 weeks end to end is what we aim for, which is normally, well, compared to a lot of the other players in the ecosystem, is a lot quicker. We strive to not to let or to manage expectations. If we're not going to invest, we try to let you know quite early and not drag you along for the ride. In terms of what founders can expect once we funded, like this is very specific to the investor that you're funded by. Holocene is a very hands-on investor. So if we look at the structure of our team, it's just actually me on the investments. I lead the investment process and the deal team. And then we have 5 people working post-investment. So if Holocene invests, it is a really structured 6 to 12 months where we do our best to take you from where we invested up into the next place upon which you can either raise additional capital. Normally that it might be debt, it might be a next round of funding, but we get hands-on and we define what objectives and key results. Some of you might be familiar with OKRs, where we really define those actually before we invest to say, guys, we're going to work with you to achieve these objectives, and we get stuck in. We're in our post-investment team are founders and operators that have built businesses themselves. We get stuck in on the financial side, helping you hire. Normally, once you've funded a venture, normally there is a hire that needs to be made. Most of our companies have 1 or 2 part-time employees, but it might be making your first hire. How do you go about that? And that normally is the most crucial thing. Your first hire as a founder can make or break your business. If you make a wrong decision there, it's really debt that is tough to shake. As an alternative, if you make a good first hire, it can really change the trajectory of your business. So hiring is a big one we assist with. We help with branding as an early stage venture, getting your name out there. PR is a huge one. And then commercial strategy. So really helping you with sharpening your go-to-market, understanding your immediate market better, with our connections throughout our portfolio and our LPs, unlocking the right introduction to make that next sale, helping you with your pricing, helping you with the strategy around that. We have quite a hands-on post-investment process. The one thing that I will add, regardless of who you take money from, is if you take venture capital money, you must realize what a VC is looking for. They are not looking to build this business with you for the next 10 years and build a lifestyle business. You need to be very, very clear and you need to understand completely that a VC is looking to sell that business within 5 to 10 years. So you must be very clear to say that this investor is going to come in and they're going to want to drive value quickly and drive a lot of value, and they're going to push you hard for it. Because that is just the way that funds work. It's a closed-ended vehicle. We can't hold them on forever. There are a couple of open-ended or evergreen funds, but most funds are closed-ended, which means if you invest, you best know that your investor is looking to exit his or her position in 5 years. So it's crucial that you understand that they're your partner for sure to help you unlock value, but they will not be around ideally by year 7. They would have exited that business, and you just need to know that that's what you're signing up for, is driving growth hard in 3 to 5 years in order to sell the business. You might end up buying the investor out, you might end up having a part sale, but you need to be very clear that that's what you're signing up for when you take VC money. Yeah, that's it from my side.
Thank you so much. It is like few seconds to 7. Thank you so much for joining us, Craig. We really appreciate it. That was such a fantastic session. Thank you to everybody who engaged, and appreciate the comments in the chats as well. Ongama mentioned never raising more than what you need, which is really, really lovely. So thank you so much for that. So that concludes our session. Our next session will be on the 30th of July. So the last Thursday of every month. That's when we have our sessions. So make sure you are following us on LinkedIn so that you can get all the information. And then also subscribe to our YouTube channel so you can catch all of this. I would love to take a little screenshot. So for those of you who are comfortable with switching on your cameras, please do, so we can see your lovely faces. And then I'm just going to take a screenshot. Then I'll hand over to Mr. Thabelo. I just like doing that because I can, to just say goodbye to everyone and to thank Craig again. So we ready? I'm going to take the screenshot now. In 3, 2, 1. Smile because it's a screenshot. Cool. Let me just get the second page. Okay. Hold on. Let's smile. 3, 2, 1. Got it. Thank you so much.
Always awkward moments with these screenshots, Ntiki. Craig, I just want to really say thank you. We appreciate your presence and the insight that you have shared on the platform. And thank you to everyone that actually made it to the session. It's good to see the kind of diversity of participants. We're seeing people from ESOs, we're seeing founders themselves, incubators, and that is the whole idea of this platform, the webinar series, to ensure that we bring the early stage ecosystem together and discuss topics that are relevant to these, and obviously all questions that were asked shape the discussion, and I hope everyone have taken away something in terms of lessons. I mean, my takeaway is there is limited funding in South Africa, and everyone is risk averse. So if you want to get money, you best de-risk your startup, understand the ecosystem, and put your best foot forward. And Tunsiki, thank you for always upholding the rules. We hope everyone was playing by the rules. And until next time, thanks everyone. Cheers.
Thank you. Bye.
Thanks, Thabelo. Thanks, Nsiki.
Cheers.
Cheers.
Thanks,
Bye.
everyone. Bye.